On a chilly March morning in 1968, the doors of the London bullion market did something almost unthinkable. They shut. Dealers who normally shouted prices over telephones were told to stand down. Central bankers held emergency calls that stretched past midnight. And somewhere in a vault beneath Threadneedle Street, the arithmetic that had kept gold nailed to $35 an ounce finally stopped adding up. If you've ever wondered how far governments will go to hold a line, this is the story. 8 central banks secretly teaming up to push back a tide, the London gold pool, and the wave that eventually broke them. To see why the pool existed, rewind to the rules of Bretton Woods. After World War II, the world tied exchange rates to the US dollar, and the dollar alone was convertible into gold at $35. Only for foreign central banks, not you and me. It was a hybrid promise. Dollars were the working oil of global trade. Gold was the anchor that proved the oil was real. But there was a built-in tension, later called the Triffin dilemma. For the world to grow, it needed more dollars. For the US to supply them, it had to run deficits, sending dollars abroad. The more dollars the world held, the more it could doubt whether America had enough gold to redeem them. The system needed dollar abundance and gold credibility at once. That contradiction is the fuse beneath our story. By the late 1950s, the pressure was visible. Europe and Japan had recovered. U.S. spending rose with the Cold War, Vietnam, and the Great Society. Dollars flowed out. U.S. gold reserves crept down. In private markets, investors began testing the $35 line. If they could buy gold at $35 and watch demand push it higher, they'd profit, and the dollar's aura would dim. The U.S. Treasury and Federal Reserve needed help. They found it in a quiet, closed-door pact, the London Gold Pool, formed in 1961. The pool's members were a who's who of post-war finance, the United States and the United Kingdom, joined by West Germany, France, Italy, Belgium, the Netherlands, and Switzerland. Their mission was simple to say and hard to do. Whenever the London price threatened to rise above $35, they would sell gold into the market, calm the price, defend the peg, reassure the world. When pressure ebbed, they'd try to buy some back. Think of it as central banks throwing sandbags onto a riverbank every time the water surged. For a while, it worked. London remained the world's price-setting hub for bullion. South African mines, then the largest producers, sold into London. Swiss houses and Zurich traders arbitraged the flows. Central banks watched screens and called traders when the tape twitched. The pool divvied up quotas. The U.S. shouldered the largest share. The others contributed according to their weight. When the price wobbled, say on a political shock or a rumor of devaluation, pool gold would quietly appear and the wobble would fade. To the outside world, stability looked effortless. Inside the room, it felt like a knife edge. Then politics sharpened the blade. Charles de Gaulle in France detested what he called America's exorbitant privilege, the ability to pay foreign bills in its own script. Paris began converting surplus dollars into gold on principle, shipping bars across the Atlantic as a statement. We prefer metal to promises. In 1967, the sterling crisis hit. Britain devalued the pound, investors feared the dollar might be next, and safe haven demand for gold rose. Meanwhile, the U.S. deficit widened. The pool's sales increased. Each defense took more tonnage than the last. By early 1968, the tide became a flood. The Tet Offensive in Vietnam rattled confidence. U.S. inflation ticked up. In March, rumors swirled that the U.S. might devalue or tax gold. Speculators piled in. Ordinary savers joined them. London dealers saw lines forming before the morning fix. On March 14th, in a single day, the pool reportedly sold more than 100 tons, an astonishing number for the era. And it wasn't enough. The next morning, London closed the gold market for 2 weeks. What began as a technical operation had become a constitutional moment for the monetary system. Behind the scenes, the pool's partners faced a choice: continue bleeding reserves to keep the $35 line intact in private markets, or change the rules France had already stepped back from the pool months earlier. The remaining members knew the math. At that run rate, their vaults would empty into a single price. They chose a split. When London reopened, the world adopted a 2-tier system. Official transactions between central banks would remain at $35. Private markets could trade at whatever price supply and demand discovered. In essence, government said, gold for you is one thing, gold for us is another. That decision killed the London gold pool without writing an obituary. Its premise, that discreet official sales could suppress the market price, was gone. A bar could be worth 2 prices at once, depending on who held it and why. Arbitrage moved to Zurich and other private centers. The $35 promise survived on paper for official settlements, But the story the market told, the price that reflected fear, demand, and speculation, floated higher. 3 years later, on a quiet Sunday night in 1971, President Nixon severed official convertibility altogether. The anchor slipped beneath the surface. Currencies would float. Gold would trade. It's tempting to see the pool as a failed conspiracy. Central banks rigging the price. But that misses the human logic in the room. The pool wasn't trying to get rich. It was trying to buy time for the rebuild of Europe, for the wiring of global trade, for a system that still needed the dollar to function while avoiding a crisis of confidence. Officials genuinely believed that stability at $35 kept the world safer. Their mistake wasn't malice. It was underestimating how quickly a growing, globalizing economy could outrun a fixed anchor, and how perfectly rational it is, during uncertainty, to prefer a metal that no government can print. There's also a quieter lesson in where the pressure showed up first. The pool's breaking point wasn't an abstract model, it was physical demand. When households, funds, and foreign central banks simultaneously wanted bullion instead of dollars, the pool met them at a single doorway: London. For a time, coordinated sales satisfied that urge, but as the macro story worsened, war costs, deficits, inflation, demand didn't just rise, it persisted. You can supply a market for a day. You can't outsupply a change in belief. What came next set the stage for our present. With the pool gone and convertibility dead, the world needed a new safety valve. The IMF introduced special drawing rights, SDRs, in 1969 as a supplemental reserve asset. Central banks diversified. The eurodollar market, offshore dollar funding, exploded, giving the world plentiful dollar liquidity. Even as gold receded from official money, gold didn't disappear. It migrated from the center of the system to the edge, where it still flashes warnings when trust feels thin. The price has since lived many lives: insurance, speculation, signal. But the habit the pool tried to suppress, the instinct to measure paper against metal when policy feels stretched, never really went away. If you're searching for the moral, resist the easy ones. The pool doesn't prove that gold always wins or that officials always lose. It proves something subtler. A peg backed by willpower lasts until it runs out of will or out of metal. In the 1960s, the will to hold the line was strong, but the math of deficits, war, and recovery was stronger. When private markets and official promises diverged, the attempt to keep one global price for gold asked 8 central banks to stand against millions of decisions. For a few years, they did. Then the tide came in. Picture that first morning of the London shutdown again: silent dealing rooms, phones that usually ring every minute, quiet, traders pacing because the price does not exist. A 2-week pause that was really the end of an era. When the doors reopened, the world had one price for gold on official ledgers and another in the lives of the people who bought and sold it. That fissure widened into the monetary system we live in now. The London gold pool was the secret battle to hold back gold, and a public reminder of what gold measures when it's allowed to move. Not just the cost of a metal, but the strain inside a promise. When the strain grows too loud, the promise changes. The pool didn't fail because the line at $35 was foolish. It failed because the world on the other side of that line refused to stand still.